New. So in this recording now, we're going to talk about investments and international operations. First thing before the people start doing the investments, they're checking where the market is. From where we're going to get information about the market? Well, the stock market information. Everything is listed. The shares which are traded publicly are listed on the stock market, to either Toronto Stock Exchange, either New York Stock Exchange, either London Stock Exchange. From that financial information, you're going to see fluctuation, current price, daily high, daily low, where exactly is 52 weeks, 126 weeks, what's the volume traded, what's the ratio, everything is there. That's from where we're getting the financial information. How we're going to classify the investments now depends on the investment. We're going to have a short-term investments and we're going to have a long-term investments. Which one is the short-term investments? The investment is held for the short term when the investment is made described in this marketable security or temporal investments. Investment obviously has to be liquid or easily convertible to cash in order to be classified as a current asset. In order to classify it as a current asset, it has to be easily convertible back to cash. And the objective of the short-term investment is to make profit from the change in the market value. Why? Because it's actively traded. So the whole point here is not to hold the investment for the long-term period. You just keep it for the short-term period, cash what you can cash, get the profit, move out. Classification of the short-term investment versus long-term investment is based on the length of the management intent to hold the investment. So here we're not going to have, is it hold for 1 year or for 2 years? We're not making that decision. We as an accountant cannot make that decision. We're going to task the management. How long you intend to hold the investments? If the management tells you, I intend to hold the investment for at least a year, then we can classify it as a long-term investment. What's going to happen if we classify the investment as a short-term? The manager says, oh, I'm just buying it and I expect to sell it in 3 months. And suddenly those 3 months become 2 years. Well, it stays as a short-term. Again, intention of the management. Investment. Now we're going to have two type investments. From the basic accounting equation, asset equal to liability and equity. Let's go back to that equation. I like that equation, so I want you to like it too and use it so you can understand and interpret everything, all the financial phenomena through this calculation. Once you understand that, everything will be easy for you. Can you guys see my screen? Not
Yes.
this screen. Let's go to the other screen. Excel spreadsheet. So let's go back to our basic accounting equation. We have asset, which is equal to liability, that will be capital, and that plus equity. Now the question is, why are we investing money? Why somebody wants to invest money? Because obviously he has money. People who don't have money, they're not looking for investments. They have a free cash. So what they have assets. What are the options for them on the other side of the equation? That's the only options that they have. One option is on this side of the equation to invest here, what they can invest in other assets. If I have more assets, I can convert them to the other assets. what will be the assets that I'm looking to invest is cash. What I can do with the cash, I can buy other assets. That's one part, one game that I may have. What's the other game? On the other side of the equation. What's available for me on the other side of the equation? Well, I can either lend money, either I can invest money. Now the question is, if I lend somebody money, what do I want? What do I expect? On the liability, we have two streams available for us. One stream is obviously the principal, and what's the other thing that I'm chasing here? Because if I lend $100,000 and the person pay me back the $100,000, I'm losing money. Make sense? Why? Because I'm not earning anything. So what's going to make it uh, interesting for me not to lose money? He has to pay me something. He has to pay me? He has to pay me interest. If he pay me the interest, then I don't mind. I can lend you $100,000. Pay me 10% interest. We have a deal. So what I expect? I expect interest, regular payments of interest, plus at the end of the period principal. So every time when you lend your money, that's what you expect. There's no other thing. There's no other game here. Only principal and interest. If you invest, would you get your principal back? No. What you can expect? You can expect only dividend. If the company decide to give you dividend. So what you can do, so once you buy the shares, what you can do with the shares? If they're actively traded on the market, you can sell the shares. You can buy the shares, you can sell the shares. But if you're holding the shares, the only thing that you can get from those shares is dividend, nothing else. Where if you lend the money, you cannot sell or maybe you actually may sell your bonds if they're actively traded, if you invest in bonds. Actually, no, if you lend your money into bonds, then yeah, you may be able to sell your bonds. But basically, you're not buying the bonds to sell them. You're buying the bonds to capitalize on the interest and to get your money back at the end. Make sense? So that's how you should see the accounting equation. I have assets. What I can do with them? I can buy another assets, or I can look on the other side of the equation. What's on the other side of the equation? Either lend money, either invest money. I can buy shares. If I buy in the shares, if it's for the short term, I can capitalize on the market change in the shares. But if I lend money, I'm waiting for the interest. I hope that cleared the picture. So now let's go back to the investments. So investment in equity, if they're publicly traded, another publicly traded company, and then it might be long-term investment, is the one that management tend to hold it and not convert it to cash for more than 1 year. If it's investment in the debt instrument of the other company, such as bonds, that will be categorized as a short-term or long-term investment. Again, depends on the management intent. How are we going to classify it? Obviously, first one, it's very important for me to understand that cash is always in the beginning. Why? Because it's very liquid. That's cash. It actually is the most liquid asset. Second liquid asset is the short-term investment. Why? Because you can easily convert it to cash. Then we're going accounts receivable, inventory, prepaid expenses, and then we're going to the long-term investment or simply investments, depends what they are. So you're going to have the short-term investments, which are equally liquid with cash. Sometimes if you have a very short a kind of term deposit up to 30 days, we may consider that as cash. But we're going to see that when we start doing the cash flow statement. Let's see how we're going to account for the short-term investments. For the short-term investments, we have again two options. Option one to invest in shares or equity. Option two to invest in the liability or lend the money. If we invest in shares, obviously we cannot buy shares for the for the private company because they're not publicly traded. We're going to buy shares for the publicly traded company. For that reason, we have to check and we have to record those one on the fair market using the fair value method or market value method. All investments are recorded initially at the cost, means whatever we paid, how much it cost us, that's how much is the value of the investment, that's how we're going to record it. But we're going to report it on the balance sheet on the reporting date. So I want you to make a difference between the recording date and the reporting date. The recording date is the date of the transaction. The reporting date is the date that we showing the financial reports to the outside people. That's why we have the recording date and reporting date. So on the recording date, when the transaction actually happened, we're gonna record the transaction at cost. When we have to report our investment on the balance sheet, we're gonna use the fair value, which will be the current market price of whatever instruments we're holding. Is it gonna be common share? Is it gonna be preferred share? Whatever we're holding. So let's see, this company purchased 1,000 common shares from this company, which is traded on the market at market price $16 per share and pay 500 commission. Now, this company intend to hold the investment for less than 1 year. So definitely short-term investment. So if it's short-term investment, we're going to show the short-term investment of the 1,000 shares at $16. The brokerage commission fee that we're paying, we're going to expense them. Those not going to go to the increase the cost of our investment. That's going to be directly expensed. And we pay the cash. Now, what's going to happen if these shares that we just purchased, common shares, company decide to pay dividend? Well, if they pay dividend, thank you very much. We're going to take it. 25 cents per share, $250. We're going to get the cash. We get the $250 cash. And that will be our revenue now, dividend revenue. Stock dividend. What if the company decide to give us stock dividends? Well, the stock dividend, that's not income. So there's no formal entry for that. We just have to put some memorandum in the notes of the financial statement. That will be all. Well, this company received 10% stock dividend on 1,000 shares. So the number of the shares increased with 10%. Instead of 1,000, become 1,100 shares. That's all. So now let's see this. This company sells 400 of the shares that we bought. So if you remember, we purchased the shares of $16. Now we're selling the shares. But we're not selling the entire 1,000 shares. We're selling only 400 shares. And we're selling it for $20. Plus we're paying $300 commission. Well, the $300 commission, that will be the expense. No questions about it. Now, the short-term investment that we're closing, it will be based on something else. So now, here the calculation is kind of interesting, but in order to make it understandable for you, is if you remember, we purchased 1,000 shares. Then we get the dividend. Then we receive the stock dividend. So once we receive the stock dividend, our cost per share is going to go down. Does that make sense?
Yeah. Yes.
Initially we have 1,000 shares, then they give us another 100 shares. The 1,000 shares was we purchased in $16 per share. When we get additional $100 shares, that's part of the. Now we have 1,100 shares for which we pay $16,000. So in average, the new cost per share will be $14.55. So now we're selling 400 of those shares, 1,100 shares, not all the 1,000, 1,100 shares, and we're selling for $20. We're paying $300 commission. We're closing the short-term investment. We're closing $400 at 14.55 after the stock dividend, the cost after the stock dividend. We're getting the cash minus $300 cash, and then we automatically calculating the gain on the sale of the investment. We know that we're gaining. The question is how much is going to be gained. Obviously, our gain is partially reduced by the brokerage commission expense. Now, if we have to report the investment on the fair value, accounting standard for the private enterprises require that equity investment with no significant influence has to be recorded at fair value at the year end. If we have any gain and losses resulting of the change of the fair value, that has to be recorded and on the same period and has to be shown as an unrealized gain and loss. Now, why is unrealized? Because technically we still have the assets. For only for the reporting purposes, we showing the change in the value. So how this gonna work? Let's assume that 1,000 shares that we bought for $16 per share increase to $18. So we're going back to the very first scenario when we're purchasing 1,000 shares. So we purchased on $16. Year end comes, we're checking the market value of the shares. They traded at $18. So what I have to do, I have to increase the value of my investment from 16,000 to 18,000. But what I'm going to do, I'm going to use account which is called fair value valuation allowance. And I'm going to increase that account, create a new account, fair value valuation allowance, and I'm going to increase that account with $2,000. And obviously, I'm having an unrealized gain. Why is unrealized gain? Because again, I'm holding those 1,000 shares. I'm not selling them. As long as I'm holding them, any change in the value will be unrealized. Either it's going to be gain, either it's going to be losses. In this case, the value went up, unrealized gain. Unrealized gain go to the income statement. Fair value valuation allowance, that's going to go as a contra account to my short-term investment. So when I combine the short-term investment, I'm going to have 18,000. Why? Because on the 18,000, I'm going to have the investment plus the fair value valuation allowance, 2,000. It's going to show me 18,000. On the income statement, I'm going to show the unrealized gain on short-term investment with $2,000. Now, I'm assuming that the $1,000, which a purchase of $16 originally, now decrease to $13. Now we have to adjust it. How are we going to adjust it? In this case, now we have unrealized loss. And again, we're going to go with the fair value valuation allowance account, which again is the companion account of the short-term investments. In this case, we're going to show unrealized loss. Why unrealized? Because I'm still holding 1,000 shares. I'm not selling them. They're still with me. Only the value went down. How is going to show this on the balance sheet? On the balance sheet, I'm going to have now, instead of 16,000, I'm going to have only 13,000. Why? Because the 13,000 represent 1,000 times $13. I'm going to carry two accounts. One account will be short-term investment, 16,000, fair value valuation allowances with the credit balance of 3,000. 3,000 credit balance, we're gonna reduce the debit balance on the short-term investments. Gonna show it 13,000. On the income statement, I'm gonna have $3,000 loss. Now let's sell those investments. Let's pretend that the share was adjusted to $13, and on January 19, we selling those 1,000 shares. So in this case, what I have to do, since I'm selling the entire amount of the shares, I'm closing my investment. I know how much is my investment. My investment is the original 1,000 shares at $16 per share. So I'm closing my investment, 60,000 gone. I was carrying $3,000 fair value valuation allowance on the credit side. Now I have to close it on the debit side. So I'm closing the fair value valuation allowance account with debiting $3,000. Next thing that I know for sure is the cash that I'm getting. Sorry, in this case, I'm getting CCC investment. Well, I'm getting $12,000 cash. So I have 16,000 credit, 12,000 cash, 3,000 fair value valuation. I'm 15, so I'm losing $1,000. I need $1,000 on the debit side, which debit represent a loss. Loss on one, loss on sale of the short-term investment. Let's do this question and see what you can get. So what's happened here? The company purchased 500 shares for $5,100. Company received 100% stock dividend, so they doubled the shares on November 30th. The market value of one share on December 31st was 630. The carrying value per share as at December 31st, how much will be the carrying value per one share? Do you have to do calculation? What do you think? What will be the answer here? Well, why are you so scared when you say B? What kind of investment is this? Let's think about it. What kind of investment we're talking about? We're talking about short-term investment, correct? So December 31st, most likely that's our reporting date. How we should report our short-term investment? At the fair value. What is the fair value in this question? The market value on December 31st. How much is the market value on December 31st? 630. So what will be the carrying amount per share on December 31st? The market value of the shares. Next time, please get rid of the question mark. So let's try this without question mark now. To entry, the entry to record the stock dividend received on the short-term investment involved. Everybody understand it's D? Why is D? Because if we receive the stock dividend, are not income. So no formal entry is required. Only memorandum entry. That's all. Let's go with the next one. Short-term investment, which is acquired for 11,500, has year-end market value 10,000. What would the adjusting entry be involved? Who else thinking about A? Only one person? Okay. Anyone else for A? Okay. Let's see this one. Reporting short-term bonds. For the short-term bonds, we're going to use the fair value method. Premium or discount, those are not amortized because we only intend to hold the bonds for the short period of time. So when you have the bonds as an investment for the short period of time using the fair value method, every time at the end of the year, we're going to see what's the value of those bonds on the market. We're going to adjust it to that one, and that's all. No premium, no discounts at this point. Accounting for the long-term investments, share investment. How we're going to do this? We're going to find out next week. That will be all for me. The one thing that I want you to remember here is first on the short-term investments. Who tells us is it short or long-term? Management. Management intention is the one who determine is it short-term or long-term. When the management says short-term, it's short-term. End of the story. How are we gonna recording those one? Those are recorded at cost. Whatever cost us, that's how much we're gonna debit to the investment. Credit cash. On the reporting date, we're gonna report it at the fair value. How are we gonna get the fair value? Look at the market. And if there's a difference, that difference always gonna go to the fair value valuation allowance. Either debit, either credit. If the fair value valuation allowance is debit, that means we have a gain. What gain? Unrealized gain. If the valuation allowance, if the fair value valuation allowance have a credit entry, that means we have unrealized loss. Who's going to determine thing? Again, our value of our investment. If the market goes up, we have gain. If the market goes down, we're losing money. What kind of loss is this? Unrealized. Why? Because we're still holding the assets. Am I going to go directly to the investment account? No. I'm going to use fair value valuation allowance account, which is companion account for the short-term investment account. And the last thing that left is once I sell the investment, if there's any fair value valuation allowance that is carried with that investment, it has to be eliminated. Eliminate the investment, eliminate the companion account, see how much cash you're getting, balance it with gain or loss, and with that. That's all for me for today.